Most people don't really know that the IWM could be a leading indicator. The IWM is the ETF for the Russell 2000 small cap stocks. And what we're seeing here is roughly around a minus 5% pullback in this ETF for the month of August. So we're going to touch on some charts and share with you what you can look for potential turning points in the market on today's Stock Market Brief. We're also going to be updating you on the daily expected moves and even getting more tactical on those 15-minute charts. It was a red day for the S&P 500 and other index products, but you can see big mega caps all the way through, a lot of red on the heat map. Cocoa Bear attacked the markets, having all 11 sectors down in the S&P 500, and each of the big index products were down over 1%. You may be wondering, well, what caused that? We had some economic data come out of China, which shows that the economy is souring, and they also cut rates, the most that we've seen, the biggest rate cut since 2020. We had industrial production down in China. We had a miss on retail sales in China, and they are stopped releasing the youth unemployment numbers. Wonder why that may be. However, in the U.S., we had strong retail sales coming out, and we had Kashkari also, which is one of the Fed members, came out and said that they might not be ready to say that they're done raising rates at this time. Remember, they're trying to fight inflation, and inflation, we just recently saw an uptick, and it's still, core inflation still remains rather sticky. We also had Fitch come out once again and warn us that they may be forced to downgrade dozens of banks, including the behemoth JP Morgan and Chase. That would be a big one. So if you looked at the 11 sectors that make up the S&P 500, you can see down here towards the bottom is financials taking a 1.84% hit to the downside. So when we take a look at what happened with the price action on all this data, what you'll notice is the S&P 500, the SPY, had a 2 sigma move. This is a fairly rare occurrence that takes place, but you can see we closed the prior day here. We gapped down quite largely on the news, came back, and this level acted as a flip, and selling came into more selling, creating a gap fill and also moving us down a 2 standard deviations. Now remember, if we take a look and think of this as a distribution curve, 68% of the time it finishes within the daily expected move. So it's pretty often that statistically speaking, we close back up there. But with all of this news, we came out to a 2 standard deviation move. And remember, 95% of the time, even more when it comes to the SPX, S&P 500, we close within the 2 standard deviation range. So when you look at that, that means we close where? We closed, it actually came outside of it slightly, but we closed slightly there in it. So it's a pretty large range on a daily expected move. When we take a look at Bookmap, we can still see those orders down here. I'll update you on this chart and what the daily expected moves look like, but we still have a lot of orders down there. We saw the dollar move higher today as well, which has not been a positive sign for the S&P 500 and other various assets. We also discussed the yield. As it rises, it's not good for growth stocks. Okay, so mix all this in together, we're seeing a pretty red day overall, as we all know. If we take a look at the DIA, which is the Dow Jones Industrial Average on the daily time frame, this one is pulling back to the quarter-to-date anchored VWAP. If this gives way, we start to look back for a potential back test of this breakout. Remember, if it comes back down here and bounces from these levels, this could just very well be a back test, and then we got to look for the strength to come back up. Or we want to see the quarter-to-date recaptured to start potentially heading back up there too as well if you're bullish. Now, we were here to talk about the IWM and noticing potential things that take place and to be aware of, because it's kind of taking place again. Now, first I want to call out that the IWM has rolled up here. We talked about it was here. We said don't really chase it up into this level. Look for a pullback maybe to the quarter to date or the all-time high anchored VWAP. Well, we pulled back into both, and you can see it's still cutting down. Very similar to how we got above it and we cut down, cut above it, came down, cut above it, came down, cut above it, and came down. So what you really want to see is this obviously is to start recovering to be more bullish. Now, the reason why we want to start seeing it recovering is because it tells us hidden signs, right? Small caps are very important to the overall economy. So when rates obviously are going higher, it not only hurts growth stocks, but it also hurts stocks that carry a lot of debt. And that could be a large majority of small cap stocks, or it becomes more expensive to service those debts. Now, if I take a look here, I'm going to put in red the DIA. This is the Dow Jones Industrial Average, and then you have the IWM. That's the Russell 2000. And what you'll notice here is the small caps typically lead the larger index products like the Dow Jones Industrial Average. So what I'm telling you here is if I say mark right here on IWM and I go straight up, you can see they have pretty much matching highs, right? So you have a high point, we pull back. We have a high point, we pull back. But what you'll notice is when we look at this high relative to this high, the Dow Jones Industrial Average is putting in a higher high, while small caps is telling us something might be wrong here, right? What drives the economy, these small caps, right? It's a big component of the overall economy, is putting in a lower high. And this right here led and gave us indication of the great financial crisis. So that was interesting, but you might be like, well, that was a one-time occurrence, things happen. Well, we can also go into multiple different times. So I thought about, okay, well, what about 2018? 2018 was also a very big occurrence going into 2019, known as the Christmas Eve Massacre. And you could see here, the Dow Jones Industrial Average was moving up higher, while small caps was actually telling us a different story as it was diverging. And that led into that, obviously, big flush there into 2019. You can also look over here at the pandemic right before the sell-off took place. What's interesting here is you can see that we had a high to a lower high in the IWM, and we had a high to a higher high over here in the Dow Jones Industrial Average right before that massive move. You can also take it another step and look at the bear market of 2022. What you'll see here is small caps try to break out of all of this, okay, and move higher. Well, also, the Dow Jones Industrial Average was moving higher. However, you can see the Dow Jones was moving higher over here, and IWM put in a massive lower high, so diverging, and that led into the bear market of 2022. So you might be saying, okay, well, what's going on now? Well, I want to call out that the Dow Jones Industrial Average is ticking up to an all-time high, and as you can see, Russell 2000 is just lagging tremendously. You can even see it on a smaller scale where you can have this high basically matching up with this high over here, where this high is, obviously clearly lower. So even on a shorter time frame, it is still diverging. So what does this mean? It tells us that small caps, right, a big part of the economy, is lagging when it typically leads. So what do we need to see if we're bullish? Well, we need to see this turn back up, which we just prior discussed. We need to get back above this anchored VWAP. We need to get back above the quarter to date anchored VWAP. But until then, we need to remain on guard. How do we be more tactical? To be more tactical, you can look at the SPY, you can look at the Qs, but what we apply, we look at a smaller time frame. By going into a smaller time frame, you could find potential pivots and shifts in the overall market. Now, we talk about the 4 stages, right, of trends, or 4 stages of, I don't even know what we call it. It's just basically stocks move through the 4 stages of market structure, I guess we can say. And the stage 1 is accumulation. The stage 2 is the markup phase. Stage 3 is distribution. And then stage 4 is decline. And then we go back, obviously, to the accumulation phase over here. And you can look at this through the lens of, a fractal lens. You can look at a large time frames like, the 200-day moving average, right? If you want to just look at how that moves and ebbs and flows, you can look at it even on a smaller time frame. Because remember, if you look at market structure, maybe this right here, this big one is the 200-day moving average, okay? DMA. We'll go like DMA. But throughout this, because it's in fractal nature, we also have smaller cycles go through this multiple times, okay? And that right there is what I want to show you, is finding the potential turning points on the smaller time frame. And we discuss this very frequently on the show. If you haven't done so already, make sure to subscribe to the channel. Now, what I'm showing you here is the 15-minute time frame, and I'm using the 5-day moving average, which equals the 130 period moving average. And as you can see right now, it's pointing down. That's the purple line. The purple line is pulling down. And when we get above it, it's a good sign where we can be bullish. Okay. However, if it's still declining, we need to have some caution. We got above it again yesterday, and we said that in yesterday's video. It's bullish, but you got to have some caution. And notice where we gap down, right? I find this so interesting that sometimes in the cash market session, if we can't get above levels or below levels in the cash market session, you might see price gap over or gap under those key levels. And that's what we did on the downside, coming below the week to date anchored view up and back below the 5-day moving average. So the trend here still remains down. So what does that mean? We need to have this trend level out, and then we need price to get back above it, and we need then the trend to start turning back up. So as it stands right now, looking at this specific chart, you need to be cautious, right? We might gap way up here, and it might go on a run and pull and do that. Who cares, right? But at least when you get into these areas or you look for the higher highs and higher lows, you might not be buying at the exact bottom, but you're buying into strength. So if you miss a little bit to get a lot, you also, escape from having to deal with all this chop and all that, just crazy movements in the overall market. Now, if we're taking a look at this chart, we have the daily expected moves. I'm not going to go over those numbers specifically because if you go into my Twitter, I'm going to provide links to these charts for the SPY and the Qs, and then you can just pull all these numbers automatically for yourself. But just note that we have not tagged the lower weekly expected move or the upper weekly expected move at this given time. Now, the reason why I wanted to show you Bookmap was because if we look at the expected move 4423, this is the daily expected move for this one. That can bring us right down to around this level, but be aware that the weekly expected move is just under that 4405, so that liquidity has just been hanging out over here. If you don't know what this is, Bookmap allows you to see really behind the candlestick where orders are hiding out. You can see these orders were hiding out at about 44.50 for pretty much the entire day today. The day started here, and we look the price action looks, or supply looks for where liquidity is below it. And you could see if we don't have buyers, it's going to find where buyers are. And where did we come? Well, we filled and we absorbed that liquidity, and that's kind of where we found our bottom. And these levels can act as potential areas of support. They can act as potential areas of resistance. So that's why I just find it incredibly important to just keep an eye on these levels, because the longer they're there, they can act like potential magnets, okay? Moving on, I want to call out a couple other things as far as divergences, or I should say oversold conditions on various charts, and that's the bullish percent index charts. We're looking at the BPSPX. It has moved into that oversold condition at 25.85. As it got back below that 70 marker, right, we discussed that, hey, when it crosses back up through 70 and down through 70, we've seen some weakness in the market. So we're starting to see that, but just be aware that even though it's relatively high, we are in that oversold condition. The BP, so the NASDAQ composite, also moving into oversold condition. The BPNYA, so the NYSE, this one's not quite an oversold condition yet, but it's not too far off. BPNDX still remains in oversold condition, and the reason why I'm showing you this is because they oscillate between overbought and oversold. When we're going into overbought, it stays overbought. It could stay overbought for a while, just like it could stay oversold. But we like to get ahead of it and tell you about it, right? So I was telling people about it here. They say, "Oh no, it keeps going, going, going." But a month passes and we're below that level, right? Or we're at the same level. So that's why we kind of give that forward-looking signal chart. If we look at consumer discretionary, this is also moving into potential oversold condition. It's not quite there yet. The technology sector still in oversold condition as it stands right now. And then another interesting one is this is the weekly time frame for the bullish percent for the gold miners. Gold miners are getting down to an oversold condition on the RSI. It's sitting right at around 30, and when it gets down into these 20, potentially even 10 or 15 levels, but typically below 25, we've seen some pretty nice bottoms form in gold miners. So this could be one to potentially keep on the radar, as we've been seeing the dollar kind of rise, putting pressure on gold, putting pressure on silver, putting pressure on miners. This could be one to potentially watch if dollar starts backing off. If we take a look at the summation index, this one is still pointing straight down. It identified the change of trend right here, and boom, the market goes down. Now I want to call out the NASDAQ McClellan oscillator. It's not quite in a pretty oversold condition, but you can see we took a pretty big move down to that direction, where we've seen typically in these areas, it's kind of oversold, where we can get some bounces, so be aware of that. And you could also look at the NYMOT. This is the NYSE McClellan oscillator traditional calculation for the New York Stock Exchange. This is now getting below 200, and when it gets down into this 200, 250, 300 range over here, we've seen bounces as well. So just be aware that it's getting a little frothy. This is the same one that we said that it was diverging as price was going higher, the internals were telling a different story, and you could see it started cracking down. The summation index ticked right over here, and that identified the potential change in trend, and it has been working out as it stands. That's all I got for you on today's episode, everybody. Hope it gave you some insight into why, though, it might be important to keep an eye on small caps and when they diverge, and what levels we need to see as far as recovery, and what we would need to see more stronger of a market, more breath come into it, obviously, and then hopefully the key levels in the market structure here helped give a good insight to be a little bit more tactical. That's all I got for you on today's episode, everybody. If you're interested in getting a part of a community, I have the Patreon group. It's $9 a month. It gets you access into the Discord. You got to sync Discord up to it, and you get access to my zones, my stock market indicators. You get, which are just a bunch of permalinks to those charts, daily expected moves, weekly expected moves, monthly, quarterly. You get access to my watch list. I give out trade ideas. This is not an alert service, and then you get access to the community as well. That's all I got for you. See you later.